Joining me now is Jim Caron. He's the CIO of Cross Asset Solutions at Morgan Stanley Investment Management. It's good to have you here.
Hey, it's great to be here, Kelly.
So what do you think the market is missing here about the non-tariff?
So it's a question of negotiations, right? So essentially what Trump is asserting is a value claim on the rest of the world, basically saying that the U.S. is at a deficit because, it's been very easy with its tariff policies. Now, some of this is about goods and trade and tariffs in that respect. But the other aspect that's probably the bigger issue is the non-tariff barriers. These are the regulatory issues, and these are the other factors that keep American goods from going abroad and helping trade. So as we try to make this like a bilateral line item by line item, you can drive yourself crazy doing it.
Right.
I think the bigger picture is a lot of these non-tariff barriers, and I think that's partially what's going to be discussed as he discloses deals. That's why it's not so clear.
So when we get headlines, like today, which is we're largely driven by whether, what's going to happen with China and whether there's negotiations underway and what the tariff level might be. Do you share the market's optimism that all of this is noise around some kind of deal being reached that ratchets the levels down or not?
I do. So this is one of the things I think is probably misunderstood by the markets, or maybe I'm misunderstanding it. But what Trump has been very clear about saying is that the tariff rate, the effective tariff rate in his mind is closer to about 12%. When you include all of the exclusions, those Section 232 exclusions. So when we think about, so what's he going to give on? I think from Trump's perspective, he's already giving a lot, in that his effective tariff rate is somewhere closer to around 12%. So the urgency to negotiate really hard with every single country, it's there. But it's also in his mind, it's like, I'm already giving a lot. So
why doesn't the market share that? In other words, if the market, which is smarter than all of us combined,
right,
said, well, it's really only 12%. This is not that big of a deal. Would we have been seeing the kinds of reactions we have in recent days?
Well, you said it. It's the noise. It's effectively when you come out with statements like 145% on China, we get fixated on that. So when we do the calculation, we come up with these really, really high tariff levels, these effective tariff rates, and that's what creates a lot of the anxiety. And then we wonder, well, is that going to change tomorrow? I think what we're starting to see, and hopefully this is a new trend, starting probably last night, is we're starting to see more clear communication from the White House. Treasury Secretary Bessent is actually making some good strides in that, and even Trump has toned down his rhetoric with China and also with Powell. Yeah.
Yeah, so then that tells you what, because we've mentioned that you're a little bit cautious on big tech and so forth, but where are you on the markets, broadly speaking? We talked to Beata top of the hour from Citi, kind of neutral on the U.S. overall things. We haven't priced in enough bad news relative to Europe and the U.K. and Japan.
Yeah, so exactly. So it's not that we don't like big tech, it's just that we like other things a little bit better, right? So when you're managing a portfolio, you're going to have your overweights, your underweights, and your neutral weights. We're slightly underweight to more neutral on the big tech sector, but what we really like is regionally, we like Europe. Europe has fiscal stimulus, they've got monetary policy stimulus, and I think that they're trying to do a lot to invigorate their own economies, and the valuations there look good. Part of this is a diversification play, right? So large cap tech, if you go back, let's go back to 2010. If you put $100 in the S&P 500, 20 of it was in IT. Today, if you have that same portfolio, it's like $40. So everybody's overweight. They have too much of this large cap tech. They're looking to diversify. Europe is a large cap value play. So regionally, it not only has the monetary and fiscal stimulus going for it, but it's got the diversification. Other sectors we like financials, we like materials, we like the broader markets, we like the mid caps. So essentially, if we look at the S&P 500 equal weighted, that's, it's faring a lot better than the market cap weighted. But the issue there is that you have to be very specific about what you're buying, because a lot of the broader market also has a really high valuation. So it's what we call the pairwise correlations between one company versus another. So when we're putting together a portfolio, we're very, very mindful of the valuation and also its connection to tariffs and to trade.